current situation so they can get on track. So it's a unique opportunity. Historically, second liens have been, everybody shied away from them because there was not enough equity in the deal. But because what happened over the last 5 or 6 years as markets have caused pricing on homes to double in price, there's a ton of equity, and Jason's going to elaborate on that. We also have a lien investment opportunity in the Atlanta market that if we have time, we'll profile that, as well as our regular deals, which are lending on manufactured homes in mobile home parks in Arizona. So,
well, good afternoon,
Alden,
everyone.
there we go.
We appreciate you being here. I'm Alden Guajardo, President of Silvercrest Opportunity Fund, Vice President of Win Mobile Homes and Mobile Mailbox Money. I'm here today with our partners, our investors, our VAs, our liaisons, here to provide you passive rates of return outside the stock market and collateralized lending opportunities, lowest risk investment in the nation in first lien manufactured housing, biggest need in the nation, and performing nature. James talked about a couple of the other deals that we'll talk about today, but welcome to the family bank here on the Mobile Mailbox Money Mastermind. We do this every week and we stream live on Facebook, YouTube, and LinkedIn. So just be aware this is a live stream. This is as involved or uninvolved as you'd like. Really, our reason for doing this weekly is to build more trust, transparency, and provide you the availability to have live due diligence questions as we talk about the deals that we do literally every single month. I think we did about $3 million last year. You know, what's our track record collectively? We probably have 100 years in real estate investment expertise on this Zoom here today. We've done 350 manufactured home seller finance transactions in the Arizona market with a 2% default rate, and also have some other creative transactions that we're doing. We've raised $15 million in private capital in performing notes and done upwards of that same number in manufactured home sales. And we're the largest dealer of manufactured housing here in Arizona. Happy to have you here today. You should be ecstatic because it's unfiltered value that we provide. And we do this all for free. And the want for transparency, you know, we have maybe 10 to 15 people on today. So that's probably one of our highest attended masterminds. So we'll give a little clap for everyone that have joined today. Appreciate you being here. Let's kind of jump in real quick. You can feel free to send some love in the chat. We got thumbs up going, we got hearts going. So thank you so much for your contribution today. Let's just kind of dive in here. I'm going to share my screen, send a request. Perfect. So let's talk about some deals that we have going on as we speak. Let's see if I can navigate around here. All right. So Mobile Mailbox Money is where these notes come available, and you can currently invest today with Silvercrest Opportunity Fund. Let's talk about these LONGHAVEN properties that we have, and I actually included it in the description. So if you want to check out these links, they're on LinkedIn and YouTube or my personal Facebook at Alden Guajardo. I open up my personal life to show you what we do on a daily basis. But these LONGHAVEN properties, we bought 12 of them from a institution here in the the West Valley. So West Valley manufactured housing in established communities on leased land. This is an institutionally owned park. These homes are brand new, never been lived in. We got a great deal on these properties. The replacement cost is about $75,000 for a unit like this. So confidentially, the institution that sold us these homes lost $500,000 selling us these homes. What did we acquire these homes for? I bought them at, I think, a all-in price of about $25,000 a door, and we're currently exiting at $49,900. Why am I even talking about this right now? Well, we have one currently pending, and I think that's going via seller carry finance. The buyer borrower is putting $10,000 down. And if you have a mortgage calculator, go ahead and whip that out real quick, because it kind of tells you how to reverse engineer what a monthly payment and a return on investment would be annualized. So at 49.5 with 10K down, I think it was. And shout out to Brandon Simmons on here today, running a couple deals in his first 40 days coming out the gate. This monthly payment, 49.5, 10K down for a 20-year term is $491 a month. So no banks, you own the first lien, you're the bank, and start cash flowing March 5th. So March 5th is when that potential payment will be due by the buyer borrower, and you could participate in that. How can you participate in this note? Well, it's kind of nimble. People like Rodney Madison on here today actually go and parlay his relationships and buy this whole note for the full yield. The whole note will yield the full face rate on the contract for a 20-year term, and he can borrow against that asset, borrowing for less than what the note pays, effectively using other people's money in a collateralized lending opportunity via hypothecation. So you could buy this note with someone else's money, pledge that note to them in order to garnish the capital investment, and cash flow, arbitraging the interest rate with none of your own money. Hypothecation's a fancy word for arbitraging an interest rate, right? So this same note, say no one wanted to buy the full 20-year term. I love that even more, actually, because I stay in on the deal. I pledge this note to get an investment, say at 39.5 for a 1-year term. At 39.5, let me just grab out my regular calculator because it would be a proposed interest-only payment. 39.5 times the proposed rate of return divided by 12 is $329 a month. So I give you liquidity potential, or really just a conversation in a year from now. Say, hey, congratulations, you've been receiving $329.16 a month, $329.16 a month for the past year. Would you like to auto rollover? Would you like to go liquid? Maybe you're buying a house, or maybe you have a daughter going to college. All areas of opportunity to provide liquidity to your transaction. And how do I provide liquidity? Well, I look to either other investors such as yourselves to re-leverage that note and provide you your capital back, or I sell that note to another hedge fund, private investor, IRA, solo 401k, or just personal investment of one of our established 100 contacts that we have that are active on our platform. These homes are kind of unique because this institution actually lets you rent these homes out. And Brandon, Mr. Simmons, mentioned that that's a great strategy for an investor potentially buy these homes and own them and rent them out, getting your depreciative tax benefits and things of that nature. Say you didn't have 49.5, you may not be liquid for 50K. We could sell or finance this home to you as the investor, and you rent it out. Maybe you refinance later, or, whatever your heart desires at the end of the day. Once you get it cash flowing, a stable rented asset, you'll be able to borrow less. Your cost of capital will be less because it's a performing asset, as these are currently vacant. So there's 12 of them. One is currently pending. We bought these under 30 days ago. And that's the note that I just fulfilled. But why am I talking about, 11, 12 of these? Well, say you wanted to buy 10 rentals and your out-of-pocket cost could be $35,000, maybe around 40, and you bought 10 rentals. Where in the nation can you buy 10 rentals, brand new, 2-bed, 1-bath in a hot, desirable market for $40,000? It's literally non-existent. So, Brandon, if you don't mind, when you ran the calculation talking about the rental potential, what was kind of some of the details that you had uncovered?
Oh, I was leaning on your dad for that one, but so I think he was saying it was they could rent. I think the payments would be all in. I think it was a cash flow of over $400 a month, if I remember right, $400 to $500 a month
on a potential of a $3,000 down payment. And what does that mean in 1 year, Brandon?
It means you get your cash on cash return the same year.
Wow.
So those properties should rent for $1,500 a month, maybe
That's awesome.
even more depending on the person coming in. But that's that's way under market. Market rent is probably like $1,650, $1,700. I think somebody could rent them quicker at about $1,500. So they're going to be netting about minimum $500 a month per deal. Now, like Alden, like you said, if we finance for the investor and they put $10,000 down, what would be their payment? What would be the difference between that payment that they would receive in rent and payment that they would have to pay?
It's about a $200 probably difference.
So to make a couple $100 and actually own an asset
with no banks.
Quick question for you, James. I know here in the Mesa area, a lot of the senior parks, they do allow rentals too, and people rent them furnished, and they're getting over $33,000 a month. They said, is that possible in this park as well?
Yes, 100%.
Holy cow! Okay,
100%. 2,000 minimum to 3,000 a month, depending on the time of year.
So a multifaceted opportunity for these now 11 that are still available. How did we buy these? We bought these from the institution. They called us. Why? Because we're Win Mobile Homes. Our signs are probably in 90% of the mobile home parks here in the Valley, and 10% of housing is actually manufactured housing here in Arizona. You know, it's not Alabama. We're not in Ohio. We're not, off in the boonies. You know, this is a move to market. The weather's fantastic. I'm just looking out the door here. We're under sub 80 degrees and time is of the essence. So if you're looking for a transaction like that, please don't hesitate to reach out right now. If you like, these are first come, first serve situations. So let's talk about another deal. I'll just share my screen again here. That was Longhaven. Get oriented here real quick. Now we have a home that an investor who had a first right of refusal wants to stay in more of a short-term component. So he has yet to execute and actually denied his first right of refusal. This 3-bed, 2-bath, year 2000 manufactured home is currently, I think, sold already. Is that right, Sonny?
Yes, it closed yesterday.
Boom. So Sonny's actually handles our transaction coordinating and helps with the agents sell the property, get them underwritten. You know, Sonny, what kind of qualifications and criteria did this buyer borrower have to fulfill in order to execute this transaction?
Well, the standard criteria is the majors of no evictions, no felony convictions, no open bankruptcies, no charge-offs on their credit that have anything related to do to home, no utilities or no charge-offs for utilities or anything like that. They have to make, income-wise, they have to make at least double what their payment would be. They have to have 2 years of tax returns. They have to have the last 2 months of pay stubs. And in this particular case, the borrower did not make the Dodd-Frank compliance for a reason that is ridiculous. Why not to make it? But they're moving from out of state, and they didn't tell their employer yet that they're moving because they're due to get a very large bonus this year. And so because they didn't do that and they don't have the documentation to show that they're moving with their company, it did not qualify for the Dodd-Frank, even though they make over $80,000 a year. They have their debt to income ratio, their ability to repay score, everything is within the line. So this is actually going to pay a higher interest rate than our normal notes, just because they don't actually qualify for Dodd-Frank on paper. But in my book, they qualify more than enough.
So, we get a 1% bump on that annualized interest rate at $60,000. The buyer borrower is putting a $5,000 down payment for a 20-year term. That's $724.23 a month. $724.23 a month. $724.23 a month. If you are on your Carl's Mortgage calculator, you notice that there's a summary option on the far right of that calculator, and it tells you kind of some specifics of the entirety of the loan. Let's say hypothetically that this buyer were to take it for the full 20-year term. Does anyone know what that total interest payment is over 20 years?
The sale price on the note was 60,000 and the borrower put 5,000 down, so the note amount is 55,000, by the way.
So you bought the note for 55,000. The total interest received over 20 years is $118,816. $118,816.22. The total payments are $173,000 over 20 years on a manufactured home. Why? Because we manufactured a note for long-term performance. The likelihood of them refinancing or paying it off, is available to them, that we have no prepayment penalties. But why is that such a scarce thing to occur in manufactured housing, where in residential real estate, the minute rates drop, people refi because it's available? There's maybe three companies in the nation that we have successfully converted a financed manufactured home unit, meaning there's scarce availability of financing for personal property manufactured housing. So their options to refinance are very limited. And not on top of that, 21st Mortgage, I think Cascade Financial, and maybe one other that really do lend on manufactured housing personal property. But they have their stringent criteria down to if they play well with the park. They hold grudges at the end of the day. Some parks they don't work with just because they don't at the end of the day. Is the home a single wide or a double wide? If it's a single wide, it may get thrown out. What's the year of the manufactured home? Doesn't matter that it's fully almost remanufactured, at the end of the day in some of these situations. But those are all areas that people just get told no at the end of the day, when the individual, I think, that is buying, the borrower buying this home in Cielo Grande that I just talked about, he's making how much a month, Sonny?
He makes over $80,000 a year.
I mean, this guy, how can a guy making $80,000 a year not get financed on a $60,000 purchase? That's just like mind-blowing to me. Why is that such a problem? Because institutions have had such a foul taste in their mouth for mobile homes. Why? Well, the Netflix series Trailer Park Boys did no one a good service by any means. But the reality is, what's the biggest need in the nation right now? It's affordable housing. It's literally on every major news feed every day of the week. And people are trying to figure out, Trump needs to go in and buy a bunch of mortgages. Oh, we need affordable rentals, but labor and material automatically price that out depending on what market. Let's do ADUs. How many ADUs can they actually put realistically in, the city zip codes that people are trying to achieve these housing solutions? You know what the biggest elephant in the room in that equation in solving that is manufactured housing. If they could figure out how to possibly do some government-backed financing on mobile homes, personal property, that would literally solve the housing crisis. Why? Because there's hundreds, if not hundreds of thousands of manufactured homes that have been left for 40 years and now need a rehab, someone such as us to come in, buy, and rehab these properties and offer seller carry financing. There's a plethora of homes waiting to be rehabbed in institutionally owned communities in desirable areas that people just don't even look at as an option. And it's literally mind-blowing to me. So those were a couple of the deals that we have going on currently. You could buy a rental.
One in particular, I feel like is the biggest gem we have right now. It's a 2000, as opposed to a lot of the ones we have are in the mid to late 70s. This is a 2000 Cavco 360 square feet. It's also not so common to find a 3-bedroom in a 55 and up community. They're usually 2-2s or 2-1s. This is a 3-2 in a 55 and up community, 960 square feet, and year 2000.
Yeah, super gem. I mean, I could care to say that we get some of the best deals in the nation. If you know someone else getting better deals, I'd love to talk to them, maybe do some business and figure out how that works. But all of these opportunities are available to non-accredited or accredited investors through mobile mailbox money. You could buy one note with one investor and cash flow in as little as a 30-day program, from acquisition costs to 40,000 to 180, and you start cash flowing at a double-digit interest rate. If you're unfamiliar with mobilemailboxmoney.com, go ahead and check that out. Go click on the website, sign up for our mailer. We won't blow you up by any means, I promise. But through our success in mobile mailbox money, we have started a fund, our 506c accredited investment fund, and we just revamped our website. I just realized. So we have some credit strategies that are going a little bit more in depth of how we operate in niche market manufactured housing and seller financing. We're doing a $50 million raise right now, trying to see what kind of interest is out there. Why would an investor invest in these positions? Well, not only is it outpacing any adjacent real estate investment strategy, but also you get the stability of one of the biggest needs in the nation and an above average rate of return when one of the most qualified and highest deal volume individuals in the nation in this asset class. So if you're looking to place capital, today, Silvercrest Opportunity Fund is currently raising. It's a $50,000 minimum. And it pays a 10% return for a 1-year term, a 12% return for a 3-year term, or a newly originated 14% return for a 5-year term. And the 1 year is paid monthly, the 3 years paid quarterly, the 5-year is paid monthly. And if you're interested in being the bank and becoming a per unit owner share in my portfolio, hitching your cart to one of the largest operators in niche market manufactured housing, this is your time to do so. So silvercrestopportunityfund.com, that's currently open, and it is an evergreen fund, so those opportunities will not go away. But that's just kind of a case synopsis of what we're doing here in the Valley in Arizona with our team. I have Jason Roberts here today. We're circling back here second Zoom of the year. We have our new strategy in second lien investments at 65% loan to value or less, with the new debt providing us an 18% return, and we arbitrage that interest rate, looking for lenders at less than what we lend at. Why is that an opportunity? There's tremendous people that are going into foreclosure, have a 2-3% interest rate, have upwards of 70% loan to value equity in their property for what they owe on their mortgage, and they can't get a loan. There should be a program where they have availability to borrow case specific against the equity in their property. And 9 times out of 10, they can't. Why? Because their credit's shot. They're actively in foreclosure. They may have filed bankruptcy. And those are all areas of conversion now with our new strategy that we deem a risk mitigated move forward in second lien lending. Our expertise provides us the availability to do so. Why? Because when and if that buyer borrower goes non-performing, we've already got the checks and balances in order to reperform that asset. So at no cost to the investor, we actually pay off the first, pay off the investor, the second lien, and fix and flip the property for additional potentially 35% equity upside in those homes. And those homes are anywhere from, $350,000 up to $1 million. So Jason, I'm ranting here. Appreciate you being here today. Let's talk about a couple more deals, because I know people are foaming at the mouth in order to see them.
All righty. And I know we talk about seconds all the time. I'm wondering, do we throw it up for questions? If anybody's any questions, just throw up your hand or throw up a chat in terms of, really what that process looks like. We have been through it to figure out how to do this legally so that the homeowner's protected, the funding partner's protected. So we have an underwriter involved in the process. We get a 4-point inspection. We get title work. We're not going to do a deal if all the stars don't align. But as Alden said, the majority of what we're doing, and I want to talk about the first opportunities as well, because I know we talk about seconds a lot, but our seconds, we get 25 or 30 a month in multiple states. And the theory, and not the theory, but really how it works is folks are coming to us who have really good equity in their property. So they might have, they might only owe 50% loan to value. And they got, like Alden said, they got a 4% mortgage that they just don't want to get rid of. But something happened, they got behind, and they're in a situation where now they owe 30 grand, because we hear it all the time. People get cancer, people get sick, they lose their job, whatever. There's a lot of reasons why it happens. The main thing we're looking at, number one, is what kind of equity is in that property. And if the equity is over, let's say 50%, then we start looking into it to see if there's an opportunity to loan them the money to get current so they can keep their first in place. Now, our loan, like Alden said, it's an 18% loan. And they know it's high, and it's high for a reason, because this is a risky loan. Traditional financing is not an option for these folks. When you're in foreclosure, nobody's going to lend you money. So you've got to go to the secondary market. The secondary market, you have to do this in such a way that it is really complicated. There's a reason that there's not a lot of people in this market space, and that's the secret sauce that we're not going to discuss. But we've kind of cracked the egg, so to speak, and we get a ton of second mortgages with high equity, low firsts, who just need somebody to kind of come in and bail out the first mortgage, give them a chance to figure out what they're going to do. And what does that mean? That could mean, hey, you got your job back. I was talking to somebody yesterday who is now in remission and back to work, and they have a ton of equity in the house, and they're so thankful that somebody would step up and actually help them versus them losing their house to foreclosure. So that process, like I said, just involves there's a lot of moving parts, but you're getting a very high interest secured position. So imagine lending somebody credit card money. There is absolutely no security with that. We can lend them money to pay off the credit card, but we're going to take a second position on their house. So we are digging through the folks that have the high equity, have a good first mortgage rate, and just need a bailout. And all of our seconds are going to follow basically that same category. They're not going to have high interest firsts. They're going to be including our loan and any potential rehab that may need to happen if we have to foreclose. The max we're going to loan is about 65%. So you're in a position where there's equity. And the good news about that equity, and I know we talked about that last week, is if there's equity, the homeowner is not going to sabotage the deal. They're going to try and work with you to get it resolved. And anytime it sounds great, hey, we're just going to take the property over and fix it. That's a whole nother thing. That's fixing and flipping. And we've been doing that 30 years. So we know that business completely. But if you can get a homeowner to come in and say, listen, I'll work with you. I will get this thing sold. So you don't have to foreclose on me. Just don't do that to me. And they get to keep a lot of that equity. That's as risk mitigated as it can get from this end of it. So the seconds are, like I said, they're high interest. They're really good loan to values, including that second and any repairs. There's a 4-point inspection. A lot of times we're not doing a full blown appraisal because we can do that ourselves. But there's title work. There's an underwriter, to look through the Dodd-Frank side of it. If that underwriter comes back and says, listen, they just don't qualify for a long-term loan, we're going to go back to them and say, listen, we still may be able to do this, but you got to sell it. You're going to lose your equity. We may be able to do a shorter term loan for you, but you got to sell it. and let them choose. Who's going to choose? No, I'm not. I'm just going to let it go to foreclosure next week. There's a timing issue with these because literally we have people that'll call us tomorrow that has an auction on Tuesday. And so depending on what time they call us, you have one business day to try and get that auction postponed. And we're getting pretty darn good at postponing the auctions, but then the work starts and you're requiring those homeowners to do a lot of legwork. We have got, I want to say we have 28 in the pipeline right now. We have, I think, 8 that have been approved by the underwriter, but we're waiting on title work or waiting on something along those lines. They come in many different states. If it's all right, Alden, I wanted to, because we get folks, there's some folks that just don't want to invest in seconds, right? They just don't feel comfortable in doing it. We need to let them know that we also have first opportunities. And I wanted to show, if I could share you want me to share my screen?
Yeah, go ahead. Oh, you're talking about literal gold out in the marketplace?
Best thing or closest thing to it. All right, here's a first. Can you see that?
Yes, we can.
Here's a first where this guy came to us and we have done, let me see, I think there's title work that's been done, pulled all, for the most part, everything. The only thing that has not been done quite yet is a 4-point inspection. I personally saw this house, so I don't really need the 4-point inspection, but an investor might, or a funding partner might. But this is a perfect example of a quality property that where you can invest in the first. The guy he's going to need about roughly less than 200, but around 200, 190s to pay off his high interest first mortgage that is in foreclosure. I have personally talked to that lender who is an absolute pain, a nightmare to deal with. And I told this guy, I'm like, you might as well just refinance. Well, he can't refinance because the guy filed foreclosure. I don't even think the foreclosure is legal, but it's out there. So he's not able to access traditional money. This is a scenario where you can see the value of this property is worth $307. It's got a pool, nice house over in a good part of Florida. And somebody that wants to come in and lend at 60, 65%, but have a first. Now your interest rate's not going to be as high, but if you want to have a first position and you're willing to get 8% on your money, we have these type of opportunities all the time. So Alden, I don't know if we want to kind of go through that, the first side of it, but we have so much lead volume that if you'll tell us what you're wanting to do, we more than likely have the lead volume. So we are getting first. We've got 2 other deals right now. One is $600,000 and another is $700,000. One is a 3-package deal on 3 houses in Texas. Another one is a McMansion in the Atlanta area for $600,000. So we get the opportunity to lend in first position as well. Some are higher than a lot of people are going to want to invest, but we have those opportunities. This one is, call it $200,000 for something that's worth $300,000. It's probably worth about $320 because it does have a pool. But we have those opportunities along with the seconds. So if you're looking to get your money, invested at a really good return with, as much mitigation of risk as you can, you're in the right place.
And just to mention, you're not buying this note by yourself and going out on an island, right? You're actually effectively hitching your cart to a qualified operator. You're still getting your collateral. Say it's this first lien single family home, right? And at $200,000 for a 1-year term, paid monthly is $1,333.33 for a 1-year term. And in a year from now, again, like I said earlier, I say, hey, congratulations. You've received upwards of more than $13,000 a year in passive cash flow in literal gold as a position, a secured position and we take care of all. And if anything ends up going awry, we deal with the difficult borrower. No investor really wants to deal with a difficult borrower at the end of the day. But we found this deal, we've instituted a relationship, and we leverage our relationships with not only that borrower, but also with the investors here today to receive collateral and a return out in the market. Sonny, you have something to add?
I love to deal with difficult borrowers.
That's just stuff that we had to learn to love. At the end of the day, we learned to deal with, and that puts us positioned great to start raising capital. And that's why we're here today. So that's a great first lien opportunity. Jason, what else do we got today?
Jason, could you clarify also what is a McMansion as opposed to a mansion?
I mean, what do they call those things back in about, what was that, 15 years ago when the foreclosure crisis happened and they had those just big, gigantic square houses. There was no cosmetics to them. They looked like, 1770, houses. Down in my area, they call them McMansions for some reason. I don't know why.
Let's just pump the brakes here real quick. Does anyone have any questions or need clarity on anything we've discussed? We'll bring up a couple more deals, but we've gone over a lot of different strategies. You can invest in the fund. You can invest in one note with one investor, all areas of opportunity. I'm just going to air it out real quick.
Yeah, I mean, for folks that are serious, get into the questions and dig into it, because I'm not sure from a protected standpoint. Obviously, if you've got that kind of equity and you've got the borrower kind of in your back pocket, you've got all the data that you need to know that the loan is really protected by the value there, and then you've got the 4-point inspection. This is easier than fixing and flipping. This is less risk because the borrower is helping you. Now, if the borrower flakes out, well, you've got the potential profit grab there. But anytime that borrower's got equity, they're going to work with you because they just don't want to lose it. And we have this conversation every single day. Mr. Seller, I'm going to be very, very blunt with you. Are you telling me that you'd rather go to foreclosure? You'd rather the bank actually foreclose at auction than you agree to sell the thing and have to move anyway. One way you're moving with no equity and they're just kicking you out. The other way you're moving with $200,000. Are you telling me that you are not willing to do that? And if they say I don't want to do that, that's where the phone call ends.
And salvaging their credit in the process too, so that they eventually can be a homeowner again.
I do have a question on the seconds. What type of CLTV or cumulative loan to value do you try to stay within?
The combined loan to value is at 65% or less with the new debt. So we're not going after a barometer of 65 and then increasing. These literally have like 50, 60, 70% equity in the property. I mean, it's like mind-blowing.
And most of them have existing mortgage rates of 3 or 4%, something really, really, really low.
Which if
I think the highest that we've gotten a response from was just 6. It was 6%, and we were like, "Oh my gosh, that's so high." That's normal.
How many have you seen that have 2 or 3?
Oh, tons. I mean, most of the averages are in the 3 to 4, where they just have killer rates, and that payment, they're not going to be, when you sit down and you explain the financials to them, you've got a 3% mortgage and your payment is $1,250. You live in an 1,800 square foot house. I want you to go look up and see what rent costs in your area. And they go see it's $1,900 or $2,000. You don't have a choice. I shouldn't have to, our office should not have to negotiate with you that this is in your best interest. And most don't. You get some hard heads every once in a while where they think they know everything and their auction's weak. And you tell them, I've said this a few times, I'll just buy your house at auction. Don't worry, I'll just buy it at auction. And that shuts the conversation down pretty quickly. But for the most part, you're getting a person that's cooperating with you with a ton of equity, a great first mortgage, who more than likely is going to qualify through Dodd-Frank or whatever. If they don't and they have the equity, we're going to still figure out how to help them. It might just mean you got to sell it. We're not going to lend you the money if you're not willing to sell it. So we've been through that whole process, and that's typically what the second is going to look like. It's rarely going to be over 65%. I've got one right now in Arizona that's 67%. So, it's one of those things like, do you kill the deal over 2%? But you have to make sure that the 4-point inspection is good. And, several things you really want to confirm before you do something like that. But we've set the level that's 65% is the combined loan to value that we're going to push. And if it goes over that, they need to do other things.
And if someone doesn't get approved for Dodd-Frank compliance for a loan like this, did you know that they actually don't have to get approved federally for Dodd-Frank compliance? Oh, how is that? I was taught that every borrower has to go through Dodd-Frank if they're a primary occupant in their home. That's not the case. If it's an open-ended private home equity line of credit, open-ended, right? That means it has no term, but it is governed by the agreement, right? So there's no maturity date on that contract, and they have a perpetual 18% interest on that loan. Say for a second, the firsts are a little bit less at the end of the day. But to know that that's actually a legal transaction, because why? It's an open-ended private home equity line of credit. We're not lending them the money based on their income. We know they're in foreclosure. They've probably got a bankruptcy. It's based on purely the asset. This is an asset-based lending component.
And that you make a great point. This is something that everybody needs to understand. We actively have people file bankruptcy to stop the auction. So don't be surprised when you say, oh, they filed bankruptcy. That is something that we're going to have them do if we need to postpone that auction and we can't do it other means. So it's not the end of the world that somebody filed bankruptcy. We've had 2 people this week pull the bankruptcy back. They did it for the sole purpose of buying time to figure out what they want to do. So that's a tool in our toolkit that we use if we have to. It's one of the last resorts, but don't freak out when you find out, well, they filed bankruptcy. They're in active bankruptcy. We've got one right now where we're waiting for the court to approve the refinance. So that's just one of the things we do. We will send out a contract. We will send out a contract to get the thing canceled if we have to. So,
and just to add here, sorry to cut you off, Jason, you do have access to the chat here on Zoom. So, if you don't want to turn on your camera or turn on your microphone, you may be in a busy place, feel free to shoot some messages over and we'll answer those in the chat. Go ahead, Jason.
That's all I was saying. It's part of the process to help them keep their equity.
Great question, Brandon. That's an important to know the term, to know the security.
Yeah, that's huge.
Good due diligence question.
Only 65% CLTV. That's a pretty low risk opportunity there. So that's why I was curious. Thanks.
Does anybody got any questions? Seconds, first, city. The first are a little bit different because obviously there's no lien to clear. You're really just straight up looking at how much am I lending versus what is the thing worth as it is. We're looking at what is the thing worth retail, and then we're factoring in the inspection and the repair side of it. If something needs quite a little bit of work, we're going to send a contractor instead of just trusting an inspector. So we'll send one of our contractors to look at it and give us a bid and tell us, hey, what do we got to spend to get retail on this thing? So we try and cover, we come at this as investors, so not lenders. I think that's an important distinction that from a protection standpoint, that's how we're looking at everything.
We're investors at the end of the day. We're here to make a profit. But at the end of the day, are we going to just take people's homes and the want for additional return on investment? We're going to put people on the street. That's not the case. You heard Jason say in multiple different ways, we're here to help at the end of the day, and that comes with the cost. But, when push comes to shove, are we going to try and work with these individuals to keep them either in their home or provide them an affordable home ownership program, or maybe we put one payment on the back of the loan, do a loan modification. Those are all tools that we have within our repertoire in order to, be upstanding citizens at the end of the day. God says that we're called to give, and we're called to hopefully provide solutions, and in doing so, hopefully we're rewarded, and we're building up our risk mitigation in order to facilitate a stable position and really a feel-good investment strategy at the end of the day. Jason, do we got any other deals to go on? Well, I think we talked about probably $1 million in potential opportunity today, all yielding, double-digit interest potential. There's some with a little bit less that come with higher level of security, like first liens, low loan to value. What more could an investor ask for at the end of the day? If you're sitting on the sideline waiting for property values to drop 50%, I got a tip for you. That's not going to happen. The realisticness of homes dropping, another huge drop in equity is far-fetched. The labor and material markets are still up from where COVID was. There is a market shortage of inventory, and we're at a small plateau here in the market right now. Does that mean that homes are going to drop tremendously? That's not the case. You see Trump kind of talking about potentially trying to ban institutions in buying single family residence. Those are all things to watch at the end of the day, but is it going to keep you from losing money with liquid capital in your account or making 4% in a bank CD? That's really the travesty. It's fear mongering is what it is. And with solutions like this to provide a double-digit interest rate and individuals that were really looking to buy a rental and cash flow, that's non-existent. Multifamily seeing huge bloodshed right now because of fluctuating interest rates. And all the above. I could literally talk for an hour about the challenge going on in the industry right now and why this should be on the top of your list for maybe a portion of your portfolio. I'm not looking for all your money at the end of the day. I would never take all your money at the end of the day. This should be a position that you fulfill within your portfolio that's for stability out in the market and an income-oriented investment strategy. We're pledging these positions for a potential of a monthly or quarterly distribution. Where can you find that 30 days from your acquisition? You go try and invest in an equity multiple with a fund and things of that nature, and they give you like a 6% pref, and that starts to fall apart after the first 6 months. These are assets that we stand behind and provide also the diversification capability that's not so much seen anywhere else. For $50,000 to $100,000 and start to stack those cash flowing assets, opposed to one multifamily complex or one multi-million-dollar flip. We're hedging our bets across multiple affordable assets in some of the highest demand markets in the nation. So we're here at 153 in Scottsdale, Arizona. If you haven't had the chance, go check us out online. Type in mobile mailbox money or type in my name, Alden Guajardo, on Google. We got books on Amazon. We have 950 videos on YouTube. 950 videos on YouTube. I don't know any other real estate investor with 950 videos on YouTube. Maybe Pace Morby, but he does paid education. I do it for the want for transparency, from walkthrough videos to client testimonials to negotiations on how to buy a mobile home to investor testimonials to industry magnates and experts being interviewed on the channel like Pace Morby, Nate Hare from Directed IRA, Kevin Shortell, the Note Investor University, with Desi and Patrick, from Mark Monroe, Eddie Speed, Jim Ingersoll from Dealmaker, Mike Del Prete, actually running for city council and owner of Arizona Real Estate Investors Association. The list goes on. I could literally spend 30 minutes, I think, rambling on the validity and value that's provided within our content that we put out for free. This is done weekly. So please don't hesitate to join us again next week at 1 o'clock Arizona time. And that's January 15th. That'll be the 22nd, I think that, or 24th. My math is not mathing right now. But also, if you have capital and you're looking for an immediate investment, we have a place for that today. Today's brought to you by Silvercrest Opportunity Fund. Invest accredited and start earning interest in as little as a 30-day program. That's one step closer to financial freedom. What do we call that? Mobile mailbox money. We appreciate each and every one of you being here. We had some good interaction going. Bring some questions next week. Please do. We're happy to kind of, be put between a rock and a hard place at the end of the day and talk, and have a true conversation. Sunny put her information in the chat. Sunny at winmobilehomes.com. You can buy a note today with mobile mailbox money. We appreciate each and every one of you being here today. Take action and start cash flowing in 30 days. Y'all have a great day. Boom. Well, that's what we do here with mobile mailbox money and Silvercrest Opportunity Fund. Tune in again next week. And start cash flowing with us. Win Mobile Homes, Mobile Mailbox Money, and Silvercrest Opportunity Fund. Call now for more information. If you don't see something that you like on our website or you're looking for additional clarity, call me personally at 602-888-2274. Appreciate it. Bye.